All right, with these sky high real estate prices, everybody is asking the question, how do I prepare for a real estate market crash? And this is a great question, and we are going to be covering it on this week, which is real estate crash week. So, no, we don't think the real estate market's going to crash this week. We just happen to be talking about real estate crashes in all of our content this week. So, make sure you give a subscribe if that's something that you want to learn more about. My name is Davin Sundvik with the House Hacker Tribe, and I give real estate investing advice so people can make more money in the real estate market and avoid any of those financial burdens along the way. So, who actually needs to be protected or who actually needs to prepare for a crash? That's actually really important before I get into the topic. So, people who own real estate need to prepare for a real estate downturn. Now, that might be counterintuitive because a lot of people would say, hey, well, shouldn't renters be prepared for a real estate downturn because they could buy houses at very affordable rates? Yes and no. So we do believe on this channel that you should be prepared for upside and downside, which means that if you're not prepared for the market to go up, then if we're preparing for the market to go down, then we're playing a guessing game on trying to time the market. And that's just not something that we teach here on this channel. We do not teach any timing the market tricks or anything like that. We teach great strategy built on data and real results. So now that we know who could actually benefit from this video, we're going to talk about some of the reasons why we might want to prepare. We might want to prepare to either protect from losing our assets, or we might actually want to be ready to buy really, really cheap real estate and invest in it and try to make massive profits from doing that. And we will talk about, like I said, all of the things that we're going to talk about will cover those two goals for current real estate investors. Now, there's two main things that will stop people from being able to acquire more real estate, either stability or liquidity. And if you got those things covered, then you're easily going to be able to protect your assets. So the hardest thing to do is to acquire more assets when the real estate market is down, not to keep your current ones. As long as your current ones have been financed with a really good financing strategy, which we have videos on in this channel. So definitely check out our real estate financing tips if that's something that you're interested in or concerned about. So if you're trying to acquire a new property and we're worried about stability, what are some things that increase our stability? Well, obviously investing in ourselves, making sure that our job or that our career is making more money and more income is definitely a good thing. Too many real estate investors see that their passive income is working for them and they stop reinvesting in themselves and they only reinvest into new assets, which is fine until a real estate market crash happens. And then they don't have the job skills that they could have continued to invest into. So always continue to invest into yourself, even when you have passive income. Another thing is to eliminate all of your personal debts. And now this might be difficult to do. You can always refinance one of your assets that's making money. And so we always accept loans that are on assets, but we do not want any personal loans. So no car loans, no student debt, no credit card debt, no debt ever that's worth spending on ourselves. Only debt on our businesses, on our assets, on our real estate. So once we've got our stability taken care of, we might want some mental stability. So that's our financial stability. Our mental stability is going to be our discipline. So if we're disciplined investors, then we're going to be way better at essentially taking action when taking action isn't easy. Now, when we talk about the other side, the other hangup that people end up with, that's liquidity. This is the ability to pay back your loans and the ability to pay a down payment or to get approval for a loan because of your available cash on hand. Now, there's a couple of ways to hold cash on hand without just holding cash. We already talked about you could refinance, which increases your liquidity. But there's another way to increase your liquidity as well, outside of just holding cash. And we're not going to even talk about holding stocks because stocks fluctuate in price. And so we're only talking about things that have guaranteed ability to have liquidity when we need it the most. And that's during a real estate downturn or during any kind of an hard economic time where there's a market crash. One of those ways is whole life. Whole life does have some disadvantages because when you have a whole life policy, you can't always get your cash back out of it. When I say get your cash back out of it. You can take a loan against it, but that's not the exact same thing as taking all of the money that you've put into it back out of it. And so if you've put maybe $50,000 into it over the course of 5 years, you might not be able to pull the entire 50,000 out until it has accrued enough dividends to pay for some of the policy premium that you're paying for. So it's a good way to diversify, but it's not the only way we can put our cash into it. What I would say is something that people need to be aware of. And this might not be right for you, but it's just something that you might want to know is available to you, is government I bonds. It protects you from inflation, which is a good thing because we don't want our cash losing money to inflation, because otherwise we would just hold cash and wait for the real estate market to crash. But 92% of the time, the real estate market is not going to crash. 92% of the time, it's going to appreciate in value. So we need to be prepared for those crashes, but we also need to be prepared for what's going to happen most of the time, which is the market's going to appreciate in value. So holding these I bonds is not going to be as lucrative as your real estate assets, but it is going to give you some diversification and it's going to hold steady. Now, some people will say that these are illiquid because you have to pay fees when you sell them, but the fees that you pay is still going to be less than the profits that you make. And so if you've been holding the bond for 1 year, it's not the 5-year term that you have to hold it for. However, you only pay a 3-month interest fee, which means that if you've been holding it for a year, you get 9 months worth of interest. So if you've got any questions on I bonds or you want to purchase them, I will have a link in the description below. We do not get any commissions from I bonds. Like I said, this was just some information that I wanted to share with you so that you had it available to you in your portfolio and in case you were preparing for a real estate market crash. Having some of this liquidity available to you might be really important for people who are very real estate heavy and are concerned about having enough cash on hand in case one of their tenants either didn't make a payment or in case they lost their job and they needed some cash without taking it out of their real estate assets. So if you got anything out of this video, make sure you get us a like and a comment down below. We love your feedback. And if you want more videos like this or want to see them, definitely give us a subscribe because we definitely plan on making more videos about this type of content. Thank you for watching and have a great day.